we're always looking for what do we think is going to happen over the next 3 years, 5 years, 10 years. And so it's coming up with what are the themes that are going to be the GDP plus drivers of the economy. And it's comes back to corporate strategy drives that, demographics, and then consumer behavior. So that's what we're spending a lot of our time doing. And that's why it's very important for us to be integrated with our colleagues in private equity, corporate credit, macro. That's how we invest.
Prominent CEOs, leading economists, iconic investors. Insights from the experts. The Walker Webcast with Willy Walker. See who's next.
Welcome to another Walker Webcast. It's my great pleasure to have my friend Chris Lee join me today. I would say after Susan just let us in, we were out at the National Multifamily Housing Council meetings in Las Vegas last week. And Susan walked up to me and she said, I was walking down the hallway and someone walked up to me and said, you're the woman who does the introduction on the Walker Webcast. And she loved the fact that someone had recognized her from the intros on the Walker Webcast. So Susan, thank you. And I'm glad you're getting some notoriety for all your great work on the webcast. I will say NMHC was a refreshing start to the year. There were 8,600 people out in Las Vegas. And I think that's an all-time record gathering of people in, well, it was the first time we've ever gone to Las Vegas, but it was a record attendance at NMHC. I would have thought that a lot of the services firms, as well as some of the lending firms, would have pulled back on the number of people there. That was an incorrect assumption. And I would say the general mood in Vegas, and I know there are a lot of people on this webcast who are there as well, was relatively positive. And I think Chris and I are going to dive into why is it that there is a general positive sentiment in the markets today, given most particularly Jerome Powell's actions last Wednesday and then the jobs report that came out on Friday. But I want to get Chris's view on all that because his view is far more insightful than mine. Let me do a quick bio on Chris, and then I'm going to dive into to our questions. So Chris Lee is responsible for KKR's real estate business in the Americas, overseeing both equity and credit investing platforms in the region. He serves as portfolio manager for KKR Property Partners Americas and is currently vice chairman of the New York Stock Exchange listed REIT KKR Real Estate Financial Trust. Chris sits on KKR's real estate equity and credit investment committees and real estate equity and credit portfolio management committees in the Americas. Chris is a member of KKR's ESG committee, KKR's Global Inclusion and Diversity Council, co-chairs KKR America's Inclusion and Diversity Councils, and chairs KKR's Real Estate Valuation Committee. Prior to joining KKR, Chris spent 3 years at Apollo Global Management on their global real estate team, and early in his career worked at Goldman Sachs in the real estate principal investment area. Chris earned his MBA from Harvard Business School and his bachelor's degree in economics from Emory University. Chris is a former trustee of St. Mark's School of Texas. He currently serves on the board of sponsors for Educational Opportunity, SEO, in New York, the Priya Foundation in Hartford, Connecticut. He's a trustee of Collegiate School in New York and is a member of the Dean's Advisory Council for Emory College of Arts and Sciences in Atlanta. So, Chris, before we dive in and back up a little bit to your education and what made you the person you are today, of those people listening, they go back and they say, wow, I just listened to the Walker Webcast and Chris Lee said this. What's the this that they ought to remember out of this webcast?
Well, first of all, Willie, thanks a lot for having me. And Susan, thanks for all your help, getting this prepared. I would say that this is my parents instilled a really strong work ethic in my brother and I. And I think that that's the one thing that's been kind of consistent through my life is if you work hard, like my dad would always say, if you work hard, you can get lucky. And I think that is, I think any young person should think about that as they embark on their career and whatever it is you want to do in life.
And from a market standpoint, you and I talked a little bit yesterday about your general outlook, and we're going to dive into this deeply, but is it a relatively defensive and kind of wait and see posture, or is it now is the time to get active and to be in the markets?
Yeah, I mean, I think what you said in your opening remarks, Willie, is somewhat consistent with our view in the markets. We're much more constructive in terms of putting capital to work to start the year. Clearly, the last 6 months of last year, especially where we were at the end of the year, there was a tremendous amount of uncertainty. I think some of the scenarios that we're looking at from an economic perspective are a lot more range bound. So we're out looking at acquiring properties. We're actually getting much more serious about bids in the market, and then we're very active on the securities and lending side as well. So we're active in the markets. We're putting capital to work, and we feel like it's pretty attractive risk reward environment that we're sitting in right now.
It feels like most of the market is sort of waiting for an event, if you will. I think a lot of people have kind of pinned up, once the Fed stops raising, I can get active again. I would also say the general sentiment I got in Las Vegas last week from a lot of investors was, I just don't want to be the first one to dive into the pool, which quite honestly, I think is kind of interesting, because not criticizing anyone who's listening in, but everyone bought at the peak and is okay to kind of put those buy at the peaks to the side and not feel like they, as an individual or as a firm, kind of didn't look that great in doing that. But no one wants to be the one who goes and buys now when everyone else isn't buying and say, oh, they bought too high. And so it seems like everyone's trying to perfectly price the bottom, even though they were happy to pay at the top. Are you waiting for a seminal event, or is this sort of just, it builds as the overall market evolves?
Yeah, I mean, there definitely is comfort in numbers, but our view is that we're not waiting for any group of investors to come back to the market. A lot of what we're seeing right now is, like you said, the vol. It was about rate volatility. People didn't know where they were going to 5, 6, or 7% on short rates and where the 10-year might end up. It comes back to the scenarios are more range bound now. We don't know whether we're going to high 4s or low 5s, but I think 6, 7, that's probably off the table. And you look at where we were summer of last year, we had inflation prints of 9%. Now we're into 6. It's clearly coming down. What the Fed is doing is working. So we're active, and then it comes down to pacing. And so it depends on the pools of capital you have. But in our view is, if we're pacing appropriately, then we're not trying to call the bottom, but we think that the risk reward in the market is, like I said, very attractive. And we're looking at yields. They're at much higher levels than they've been. We're looking at replacement costs. We're looking at development pipelines coming down. So we're looking at a bunch of different factors that give us a more of a green light than a red light in a market like this.
So given that KKR manages over $500 billion of capital, Chris, and the breadth of the platform, many people on this call are, if you will, very focused just on the commercial real estate space and very focused on commercial real estate in the United States. The breadth of the platform that you sit in gives you a very distinct view on sort of global capital flows and whether capital is flying to what asset class, what geography, et cetera, et cetera. Does your view as it relates to commercial real estate and in the Americas go across, if you will, KKR writ large? Or is your viewpoint as it relates to, we think we're a little bit more range bound now, things are looking like we can get into it, and we want to be very consistent here and not just kind of like jump in at one moment and pull out at the next? Is that similar to KKR writ large, or is that really more of a specific US commercial real estate view?
Yeah, I mean, when you think about commercial real estate values, we think there are kind of 3 broad things that drive valuation. You've got fundamentals, then you have capital flows, and then you have the macro. And all of those are really things that we're observing outside of our real estate business. You said, let's start with fundamentals. Well, who makes real estate decisions? Landlords don't. We could sit around and talk to each other all day. We own real estate. The people that make real estate decisions are consumers and corporates. And then you think about, well, what drives some of the big moves in real estate? It's these consumer preference changes and then demographic shifts. And then it's a rate sensitive asset class. So we're always trying to figure out what's happening in the macro, what's happening with GDP. And of course, the last 12 months, it's been dominated by what's happening with rates. And then I think your point on capital flows is really important. And so we've seen some pretty constructive activity to start the year. I mean, we have a huge corporate credit business. The high yield market has come in 70 basis points to start the year. There's not a lot of supply. You're starting to see real signs around primary issuance. And so when you think about what can move money out of real estate, it's because you can go get a lot of yield somewhere else. And if that kind of alternative becomes less yieldy because spreads start coming in, then you can see the capital markets on the real estate side get more constructive. So what we're seeing in high yield makes us feel better about what we're seeing in CMBS spreads. And by the way, CMBS spreads have come in. So we're always looking at these big kind of tectonic plates that are moving around capital markets and in the macro, which then informs our decisions on how we want to think about risk in the real estate markets and even specifically around different asset classes and geographies.
So you have been a very large buyer of both CMBS as well as B pieces on CMBS. How do you feel about that market right now, given your comment on high yield?
I mean, CMBS spreads to start the year have come in a lot. I mean, the first conduit deal of the year was, very well, oversubscribed. There was a, SASB deal by, one of our large, brethren in the market that was, went very well, last week and is still kind of out in the market. And so we're seeing these signs that are saying people are coming back in the market, people are taking risk. And by the way, there are a lot of institutions that have to put cash to work because they have, liabilities, they have other things that are driving that desire to go buy assets. And in a world like this, where there's not a lot of new primary issuance or supply, then that drives spreads, spread compression. So we think that the CMBS market is starting to heal, and that's across the conduit and the SASB market. But we're seeing, and even floating rate CLOs. I mean, we're seeing all of that, come in to start the year.
Are you, given where the markets are right now, you've got a huge equity business and you've got a huge credit business. Are you, if you will, overweight on the equity side right now, given where valuations have moved? Or are you overweight on the credit side, given the liquidity we're seeing in the debt markets and the need for your capital?
I mean, listen, that's one of the nice things about our business. We've built a business where all of the risk prices at one investment committee. So if we're making a loan or we're buying securities or we're going to buy an individual property or a portfolio, all of that risk rolls up to one investment committee. So we are seeing relative pricing across a first mortgage loan all the way through looking at, the equity at the bottom of a capital structure. It definitely still is a lender's market. And so lending is there's just scarcity of capital given the banks have pulled back, since the end of last year. Starting to hear some signals that they're coming back, but right now we definitely think it's a lender's market. So the relative value in credit, whether it be securities or direct lending, is still quite attractive. Like I said at the beginning, we are starting to see on our equity side, we're starting to see assets that are pricing at levels that we are starting to get excited about. Whether it's discounted today's replacement cost or whether it's the yields, whether it's the risk profile of the assets that we can buy, given some of the the REITs and core players aren't in the market. There are a lot of things that we're seeing that are attractive on equity, but I'd say the rel val is probably still probably skews a little bit towards credit right now today.
KREF reported, I believe, last night or first thing this morning, earnings, and had a write-off of, I believe it was, a loan on an office building. What's your take as it relates to credit, kind of generally speaking on commercial real estate, but more specifically, let's use that as a launching pad to go into office for a moment?
Yeah, I mean, listen, I would say real estate credit more broadly, this cycle was all about interest rates. Rates were super low coming out of COVID. We had a tremendous amount of monetary and fiscal stimulus that went into the market. In that type of environment, real estate, clearly did very well, but we didn't have overbuilding, and we didn't really have oversupply, and we really didn't have over leverage. So when you look at even in a more normalized rate environment that we're in, or even a more restrictive rate environment, a lot of asset classes are still performing well on the fundamental side, primarily housing assets and industrial. And so we're not really seeing credit issues in those types of deals. And then for our lending business, we're generally lending to top sponsors. We're lending in the most liquid markets, moderate LTVs. Office, I think, is a totally different. It's just a totally different asset class right now in terms of the fundamentals are more challenged there. And I think some of this is, secular, right? We did a massive work from home experiment, starting in March of 2020, that every firm across every, industry did, starting that, weekend we all went home. And a lot of places are trying to figure out how do we get more efficient? How do we compete with, in a very tight talent market? I mean, unemployment for college educated workers is 2%. I think it was 1.8 in fall of last year. So there's basically no ability to access talent. So some types of fields are trading on, oh, you can work hybrid, you can work a few days a week. So everyone's looking at their real estate footprints as well as their headcount and trying to figure out how to optimize that in an environment where companies are much more focused on margins and more traditional metrics versus just growth. And so I think office will continue to be challenged. And then there's of course this sustainability overlay and capital markets overlay that comes into play there. So I think there'll be clear winners and losers, but I think office is, you almost have to take that as a separate sub asset class within the broader real estate market, because it's going through a secular change, just like retail did over the last 15 years.
KKR is back in the office. You learned the investment banking business being in the bullpen at Goldman Sachs, and how much you learned having someone sitting across the way and showing you a model or talking about something or hearing a partner or managing director make a comment about how you interface with a client or what have you. What's your take as it relates to back to office versus remote? And do you think that there is a paradigm that allows for both to work together, or do you think that it's got to be one or the other?
So I think your point on how young people learn, I mean, I did sit in a bullpen at Goldman Sachs, and there were a few things about that experience. I worked a lot, I learned a lot, and I made some unbelievable friends that are friends of mine still to this day. And that I started at Goldman Sachs, I guess now over 22 years ago now. And so you can't really do that in a hybrid environment. And then let's talk about what we were doing at KKR. We've been back in the office since really summer of 21. We moved from a different space into our headquarters here at Hudson Yards, which is where I am today. We are an in-office culture. We just function much better in the office. People can collaborate better. We're an idea business, we're a relationship business. How do you come up with ideas if everyone's, people aren't together? How do you build relationships internally, the types I was talking about, where you can really pick up the phone and get access to information across any asset class, any market in the world? You have to build those relationships by being face to face. And so we believe that our culture, we get the best out of our culture, and we deliver best for our investors if we're in the office. And so there are, I think, a lot of functions out there, though. We're not, I think, indicative of every single office user in the market. There are a lot of places where the job is to come in and sit at a cube, you do a job, and then you go home. And there are hundreds of millions of square feet of office that's filled up with people doing more things like that. And I think that's where there's a big debate on how much office space people need for that. But at KKR, we're in the office. I like being here every day. When I'm home, if I'm sick or something, I'm bored and there's no one around. My kids are at school. My wife is staring at me like, why? What are you doing here? So I like to be at the office.
Does it concern you at all, Chris, that I know you took additional space in Hudson Yards, and the space that you picked up was space that Meta had originally leased from Related, and you picked it up from them. Does the sort of reversal, as far as tech companies were the big acquirers of space in 2022? You saw the leasing volumes in 22, and it was, Meta was taking this space in Austin, and, Google was taking space there. And they're all now both shedding space as well as shedding employees. Is this from your view, is this a kind of a tectonic plate that shifted as it relates to office users of the technology firms, or is it just a timing issue as it relates to them having to scale down and giving back some space as they're trying to right size their operations?
Yeah, it's a good point. I mean, we're the beneficiary of that. We need more space. It's going to be great when we can occupy that. But I think it's more indicative of what you're saying, which is a broader theme in the market. You had basically big tech, but you also had emerging tech that were the marginal users, not just in Silicon Valley. They were the marginal, lessees in a lot of markets, and they were taking big blocks of space. They were leasing, way ahead of their growth projections. And when you think about, companies whose cost of capital for several years is really zero, they added a lot of headcount, and then they added a lot of real estate. And you think about what are the two biggest costs for a company if now you're all of a sudden you're focused on margin. Well, it's people in real estate. And so we're just going through a rationalization period with some of these companies, but I think that it is going to have a really significant impact on some of these office markets where you have these companies pulling back at a time when every company is rationalizing their office space. So you have some of these markets that are quite dislocated when you add in the sublease space availability rates in the high teens into the 20s. And then you have a market like a DC, for example, and you have, the federal government for different reasons, not really bringing people back to the office, but it goes back to this competition for talent. I mean, a commute is actually, can be a tax. So you have different markets that are dealing with different things, but I think across the board, everyone is looking at their space. But I think, in a lot of the, big markets, tech was a big marginal user or big marginal lessee of space in those markets.
Your private equity, if you will, side of the business owns hundreds of businesses, maybe even thousands of businesses. And I'm assuming that, as you sit around the water cooler and talk to people, they sort of say, we're working on cost savings of outsourcing technology to India, for instance. We're working on cost savings of this and that there's always kind of a theme of the day. Is one of those themes on the private equity side the office footprint of the portfolio companies that you have, and that being kind of a long-term potential cost savings? Or is there any conviction on the private equity side as it relates to that?
Yeah, it's interesting you asked this question, and it's kind of interesting the way our firm works. We got ahead of this, really before the pandemic. We weren't really investing a lot in office. We have some office exposure. I guess that time we were investing our second U.S. fund, but we had primarily focused on the Sun Belt. But if you look at what we started doing after COVID, we have, I think, done just a handful of office deals. And when you look at our opportunistic, our core plus strategy, it's, you can count them on, a couple fingers. And so a lot of what we were seeing was through our private equity look through. We actually surveyed a bunch of our companies during the pandemic, and I think we surveyed 50 or 60 of our US companies on a bunch of different real estate related topics, how they were thinking about talent nodes, how they were thinking about office space, for those that it mattered to, their logistics footprints, how they were thinking about, retail, et cetera. Probably 30, 40 questions. And our macro team and our capstone team really led this effort. But when you look at what came back, it was very clear within a few months after the pandemic that people had office space high on the list. And so you're getting that from the C-suite of dozens of companies that we control. And then it's getting reinforced by a bunch of our colleagues and partners who sit on the boards of these companies. And so we really took a shift. And if you look at our exposure to US office, our global portfolio, I think it's less than 5%. And so we really started shying away from this, several years ago. But a lot of that was what we were seeing through effectively the boardrooms of the companies that we control.
And I think, Chris, similarly, you made a big play since 2018 in logistics. You've bought over $7 billion of logistics assets in the industrial sector since 2018. What are you seeing there? And I think it's about 45 million square feet. What are you seeing in the logistics / industrial space that you still like at this point?
Yeah, I mean, the fundamentals are still very strong. And when you think about what was really driving it coming out of, the GFC, it was just how goods were reaching consumers. It was the onset of e-commerce. But what we've seen over the last several years is it's now shifted to onshoring, supply chain resiliency, supply chains moving from just in time to just in case. And so a lot of the logistics build out is not just this e-commerce migration. It's several other factors and themes that are driving that that need for space. And so it's also shifting where goods are even showing up in the country. I mean, goods a lot of goods would come in from Asia. They go to the Port of Long Beach and they get distributed across the country. Well, now you're seeing a lot of those goods show up in Savannah and Jacksonville and other ports on the East Coast going through the Panama Canal. So that even changes where logistics is needed. So that also goes back to a lot of those insights were things that our team and our colleagues were working on with our macro team and people in private equity. But we still feel good about the fundamental story there, and we're still seeing very strong leasing demand. And the nice thing is, like you said, we have a quite a large platform, so we're leasing every day, and over a dozen markets. We're buying, we're selling, and so we have a very good feel for what's going on the ground in those markets. But it's still quite positive.
Is there anything from an industrial viewpoint geographically, Chris, that you see evolving here? So, I mean, when you talk about, for instance, there are a bunch of people who are saying, I want to stay away from sort of high political risk environments because of either rent control or something else. So I'm going to stay out of California and potentially New York, what have you. But at the same time, from a logistics standpoint, those are still New York, not so much, but obviously California and some of Texas, Louisiana have big ports that are very important for logistics as it relates to distribution networks. Is the geographic overlay that you have to keep in mind wildly different as you think about various asset classes that you're investing in?
Yes, we are always thinking about the quality of the cities, because if you think about what creates real estate demand, it's population growth and then business activity. And so what makes a city attractive to businesses and people? Well, you need great physical infrastructure, you need great educational infrastructure, and that means universities and in and around these cities. And then you need, people don't think about this, but you need cultural infrastructure. And so you think about like what makes a city attractive to young people. You want to be able to go do things. And so like, why hasn't Austin thrived over years? Well, you've got great cultural things for people to do, and you can't just go build those. You can't go create sports teams and create South by Southwest and film festivals and music scenes. Those are things that are part of cities that make them, if they're attractive for young people, then businesses are going to go there to have their talent. So that's why people have gone to the Dallases and the Atlantas and some of these places, because they're attractive. And then you've got cost of living and other things that come into play. But people want to live in cities that are dynamic. And so we are always looking at which geographies are going to get an outsized share of GDP growth, because if GDP is growing at call it 2.5% real, that is wildly distributed across different MSAs. And so there are some MSAs are shrinking, as we know, and then there's some MSAs that are growing very rapidly. And so we're always looking at that, re-underwriting what makes those cities attractive. And I think your point is also right. You're looking at the political environment and whether you can continue to attract great companies and great highly educated young people.
There are two things that come to mind on that. The first one is KKR has vast resources. You've got internal economists. You can buy any research you need to, and you're getting it across not only commercial real estate, but on a much, much wider sort of macro view across industries, because you're investing in all industries, et cetera. Where's your research come from, in the sense of how much of it is proprietary? Were you using your own data feeds and your own analysis versus buying a CoStar report or a Real Capital Analytics report that most people who are listening in on this would go and, if you will, buy off the shelf research? Are you taking basically public data and scrubbing it like most people do, or are you doing a lot of proprietary research that you think gives KKR a unique insight into markets?
I mean, listen, we're big users of CoStar, Real Capital Analytics, and I think a lot of that data, though, is backwards looking. It's what has happened. It's what has traded. It's looking at it's what's in the newspaper. And so we need all of that data. And so, like I said, we consume that, but we're always looking for what do we think is going to happen over the next 3 years, 5 years, 10 years. And so it's coming up with what are the themes that are going to be the GDP plus drivers of the economy. And it comes back to corporate strategy drives that, demographics, and then consumer behavior. We're trying to understand those three things because that ultimately drives how consumers want to access goods. Where do they want to live? How do they want to live? Do they want to work in offices or do they want to work hybrid? Where do companies want to hire people? Do they want them in the office or not? I mean, those are the decisions. Do they care about sustainability? Those are the types of questions we're always asking because those will inform us of where the world is going. And that's where we're trying to invest, or where the world is not going. And then we can avoid sectors that we think are getting deprioritized from an economic perspective. So that's what we're spending a lot of our time doing. And that's why it's very important for us to be integrated with our colleagues in private equity, corporate credit, macro. That's how we invest.
It's really interesting that you say, Chris, kind of what are corporations doing? Because it feels like as much as the Fed is trying to slow things down and everyone's kind of focused on what's the Fed policy doing and how's that changing the world we're in, that many corporations are starting to take a different view about what 23 will look like and almost looking beyond any type of recession that might be out there. That it feels to some degree, particularly in the last week since the jobs report came out, that it was almost like, okay, Fed raised by 25, jobs report came out much healthier than anyone expected. Maybe we can kind of push through this from a corporate growth standpoint, even if the Fed's trying to slow things down. Am I misinterpreting the data, or is that sort of the general sentiment you're feeling around with your private equity colleagues who are sort of investing in businesses and thinking about not just what 23 looks like, but 24, 25?
Yeah, I mean, listen, a lot of our companies, a big input is labor, and we've got a great industrials practice here, consumer practice, and you look at what was fourth quarter real GDP grew 2.5%. I think nominal was in the 6 range, but what's population growth in the country? It's sub 1%, and then you take out immigration. What's organic population growth in the country? And so labor markets are extremely tight, and we're seeing that in these jobs reports. I mean, it also just shows how offsides the Fed was in the first place. We had rates at 0. We were putting fiscal stimulus in, and now rates have gone from 0 to almost 5, and the job market, hasn't blinked. And so it's we think that that's structural until we figure out how to grow our labor force. You're going to continue to have quite tight labor markets. And yeah, some of this might lag a little bit. There are some layoffs, and I think we are focused on corporate earnings and seeing how companies deal with margin compression, where they've had a lot of margin expansion over the last several quarters. So it is something we're focused on. But I think coming back to these labor markets, they're extremely tight, and that's it. The kind of unskilled or lightly skilled labor, you're still hearing a lot of construction markets are still tight, even though they've started to level off. But on the when you look at unemployment on the college educated side, I'll tell you, the stats, it comes out every month. When you look at, I think it's by educational attainment, it's sub 2%. And so it's just, that number is, you can't change that unless we're growing our population or people are coming into the country.
And all those people need to live somewhere. So you're overweighted both in your lending business as well as your property business on multifamily. What's your feel on multifamily? And if you can, any general themes? I mean, to that point about college educated being under a 2% unemployment rate, that would say major urban center A class or B class multi. Do you still like that given where valuations have gone, or are you zigging more towards those unskilled, semi-skilled laborers who might be in a secondary or tertiary market that need workforce housing?
So we play across the spectrum. I would say we're focused on basically top 15 cities. Like we might buy workforce housing and class A housing in the same city, but we're not really in the what I call like secondary and tertiary markets. We do believe that these urban centers will continue to grow, and that could mean a city like where I'm from, Dallas. It's growing in many different pockets, but it comes back to you got these places with big airports. You've got hundreds of thousands of college students and universities within a few hour flight. Those cities will continue to in our view, outperform. Now, we like, I think, Class A housing. We're a big owner of of Class A housing, but demand has to stay in check with supply. And so some of these markets, the thing that we are focused on is supply pipelines they are delivering, and it's mostly a certain type of product that's targeting this higher educated tenant base. So you can have, if you grow demand at 3%, but you grow supply at 5%, you can, rents can go down. It's a supply and demand have to be in check. So we are focused on these supply pipelines that in some markets seem a little bit elevated around a specific product type. But longer term, we like housing, we like multifamily, we like student housing in a lot of markets, and we have long-term holds as well as more opportunistic plays that we've made across all of the housing sectors.
A lot of your big private equity competitors got into the single family rental built for rent space, and now have public vehicles that came out of their investments from the private equity firm. What's your take on SFR, BFR right now as it relates to an alternative to either single family or to multi?
Yeah, we think about it as it's part of the rental housing market, and we own single family homes across many of the markets that we like longer term on the traditional multifamily side. So we don't think about it much differently. Now, you need to have a great platform because you're operating at scale. It's very different, operating hundreds of homes in in a jurisdiction versus a 300 unit garden style multifamily house. So a lot of the technology and the and the infrastructure that we've built out through our operating platform is very important. But we think about that as just part of the the broader housing market, and we're in there as an institutional investor, just like the other forms of housing that we mentioned.
If you were heading out, Chris, to raise a new fund today, and I'm assuming there are a lot of strategies that you all are constantly out talking about, but one of the issues that came up a lot when I was at NMAC last week, as well as talking to a number of clients, is should return expectations come down? That as cap rates have adjusted, are we in sort of a structural shift? Are investor sort of return requirements permanently shifting, and should you bring down your yields, or should you hold with where it was and we're kind of at an anomaly right now? What's the, if you will, what's the KKR view on, you're going out to raise some new multi-billion-dollar fund? Have you shifted your yield expectations, or are you holding of a print today would be the same as it was in 2019?
Yeah, I mean, I'd say the short to medium term, our return expectations are higher. And when you think about what's the component of a return, there's risk-free rate. Risk-free rates are significantly higher than they have been since since the financial crisis. So we're talking about now 13, 14 years, and then risk premiums are elevated on top of that. And so a lot of that is due to uncertainty, cost of financing. And so the unlevered returns that we are underwriting right now are kind of at the highest levels that we've seen in a number of years. And a lot of that is we're buying it, wider cap rates. And then with growth, even assuming, not a lot of cap rate compression on the back end, we're assuming unlevered returns that are, much higher. And that's why at the beginning, I was like, we're starting to get much more, excited about this investing climate because, in our opportunistic fund series, we're seeing some very attractive deal profiles right now. But to answer your question simply, unlevered return expectations for us are higher, and we think we're seeing that across the market, and that's what's pushed cap rates up for for a lot of different asset classes.
It's a really interesting comment coming from someone who, if you will, understands the global capital markets as well as you do and as well as KKR does. Because I do think that there are a number of people who are not as broad, not as wide as your platform is, who sit there and go, well, there's no way that yields can stay where they are, given the pricing pressures that we've seen, and we need to kind of adjust our returns because it's a very different market today than it was just a year ago. And so it's it's reassuring to me, if you will, to hear you come out and say that, and particularly given what you're seeing on the unlevered yields that you're getting on the both existing investments as well as prospective investments that you all are underwriting.
Yeah, I mean, Willy, real estate in most institutional portfolios, it competes. It has to compete with equities and fixed income and other asset classes that yield infrastructure. And so if cap rates don't move in real estate, then a chief investment officer of an insurance company or a pension fund is just going to shift that allocation to high yield. And so when we're looking at, what was happening last year and cap rates were moving out, a lot of that was being driven by, you could go get high single digits buying, first lien bonds for a while. And so that capital has to flow where the attractive relative val is. It can't, stay in real estate unless real estate, adjusts. And then vice versa. If we end up in a world where risk premiums come down and, credit spreads come in and, base rates come back in over some period of time, then, all asset classes, all risk assets can benefit from a, multiple expansion perspective. So it's just having that view that there's a lot of capital that can move quickly, and it doesn't have to be in real estate. It can be in something else if someone can get a better return.
Talking about the diversity of, if you will, capital flows from one asset class to the other, KKR's real estate platform is global. And while you're responsible for the US, you have a lot of input on what you all are doing in other places. You've got a Europe fund, you've got an Asia fund, you've got a Japan fund. As it relates to, where global capital is looking for a home as it relates to commercial real estate, is the US at the top of the pecking order right now, or is there a real play in Europe for various reasons that Europe's the place to be, Asia the place to be, or more specifically your Japanese fund?
Yeah, I think it really depends on where the investor is domiciled, because with some of these interest rate moves, you've had some big currency swings, in the market. So it really depends on what's the investors' home currency and what are they really translating those returns back into. But we're seeing, we're seeing demand across the board for our products. Clearly, the second half of last year, when there's that much uncertainty in the market, when there's that much, when you think about denominator effects or other asset classes going down in price, that definitely puts a lot of big institutional investors on pause, or at least makes it take them longer to make new commitments to funds. But I think ultimately real estate is now an established asset class. When we think about the US, it's an established market, rule of law, et cetera. So we believe that there will continue to be a lot of demand for our asset class here and also around the world. I think what will really be interesting is how people make the decisions on manager selection and who they want to entrust with that capital. And so it goes back to, what is your investment process? What is your differentiation? How do you make decisions? What information do you have access to? We think a lot of investors are really digging into that and really holding a lot of us and our competitors' feet to the fire on what is your secret sauce, like why you and not someone else.
Is there anything? I'm an investor with full disclosure in the KKR Asia fund on the private equity side, not on the real estate side. I'm just curious as it relates to your view on China. And I guess two kind of specific questions there. Peter Linneman, when he was on 2 weeks ago, Chris, he mentioned the fact that a big driver of hotel occupancy in the United States pre-pandemic was Chinese tourism. And I heard him say that and thought about the fact that if you were to go and invest in a hotel today that had been occupied by a lot of Chinese nationals who came to the United States, and then it went down, if you have a bet on China opening back up and getting back to the tourism that we typically would expect from China, that wouldn't be a bad place to be right now, because that asset value is way down. And that once they open up China, then everyone starts traveling back to the States, and they'll go to those same hotels that had, for whatever reason, from a booking agent standpoint, from a service standpoint, from a location, because there's something that Chinese tourists like to go see, that might not be a bad bet right now. Are you all making any bets as it relates to kind of the macro political view on either the lockdown in China being released, or tensions between China and Taiwan that says we don't have visibility into that, we're just going to stay away until we see that type of a geopolitical potential friction point ease?
Yeah, so listen, we've got a lot of expertise around China, given that we're investors there in our private equity business as well as our real estate business. I'm not the expert on China, but I think the one thing that you said that we are focused on as it relates to US investing is the reopening of China. I mean, you're talking about second largest economy in the world, that's kind of had rolling lockdowns for, we're almost 3 years into this. And so that, I think, is a major, will have major implications, positive implications, if they get back to a level of normalcy. I think part of it, like you said, when you have 1.5 billion people, a lot of people moving into the middle class, when those people start getting out and spending money and traveling, and that creates a lot of economic activity that has probably been somewhat restrained. And then also, when you talk about supply chains, and there's some relief on some of the supply chain issues that we've had here in the US, that is also something that has been a little bit of a headwind to our economy. So I do think that is a positive once they get back to kind of full scale. But some of the more nuanced questions around the geopolitical environment, we have better experts on that than me.
Yeah, but it's I think it's honestly a very interesting one as it relates. Yes. They're going to open at some point. If you bet properly on that, and you buy something that is very impacted by that opening up, you could make a great play right now. And then the question is where and when. And if you've got any kind of conviction on that, it really could end up being a fantastic investment. Yeah, no, we agree. And we've got, like I said, we've got a great team in Asia on the real estate side as well as the private equity side. And my guess is we're all over that. And like I said, in the US, it's much more around just getting back to a kind of a fully functioning economy, which in the US, China is a part of that, given how much of an impact they have on supply chains in many of our industries here, including real estate. Yeah. I want to shift for a moment here, Chris, to you're on the board of SEO, and SEO is chaired by Henry Kravis, founder of KKR, one of the founders. And at SEO, one of the things that was noteworthy to me was that they create an ecosystem of excellence. And SEO got you your first internship on Wall Street, but kind of a little bit of a broader question, not specifically to SEO. They talk about an ecosystem of excellence. You have been in a lot of ecosystems of excellence. You started out at St. Mark's School in Texas, clearly an ecosystem of excellence. You went on to Emory University, clearly an ecosystem of excellence. You went to Harvard Business School, another one. You went on to Goldman Sachs, another one. Then to Apollo, and then to KKR. Every one of those is an ecosystem of excellence. If you had to sit there and think about which one, and you're at KKR, so you're somewhat biased to it. So maybe let's just say KKR is the best ecosystem of excellence there possibly is. But that's the best. They're the best of the best. But for a moment, Chris, just as you think about those ecosystems of excellence and what provided you with either the learning or the relationships to get to where you are today, which one of those ecosystems provided you with both the training and the relationships that got you to where you are? And they're all cumulative, and a St. Mark's is distinct from a Goldman Sachs. But if you could. Well, I think when you put it like that, it's you need to get a start at some point. And so I can't be here talking to you if I didn't get the opportunity to go to St. Mark's, if I didn't get an internship in 1998 in the mortgage department at Chase Security. They're all, like you said, they're all cumulative. And so when you think about what is the premise of SEO,
it's a very simple premise that talent is evenly distributed. Opportunity has historically not been. And so what are we doing at SEO in all the different programs? We're just matching talent with opportunity. And there's just been a gap there. And if you think about why that's important for our country, if we want to maximize, our productivity as a country. So if we have excellent people that never actually get to an opportunity because they just never match up with it, that's a lost opportunity. And so that's why that's literally the name of the organization, Sponsors for Educational Opportunity. But it's about having the opportunity to go to Wall Street. I didn't know anything about Wall Street. My parents were both in healthcare. But I worked hard, and I found out that SEO existed, and I got an internship, and that actually led to, the next now 25 years of my career. But without that internship, we're not having this conversation.
And you and I have spent plenty of time talking about women and minorities in commercial real estate and the fact that both of those groups are underrepresented. You've taken a significant leadership role both inside of KKR as well as in the industry as it relates to trying to create opportunities, trying to recruit more women and minorities into the commercial real estate industry. Talk for a moment about what you've specifically done, and I think almost more importantly, Chris, where you've seen success.
Yeah, I think what's interesting about the real estate industry is it historically was, very much driven by families, and so there were a lot of families that owned properties, and then over time, some of those, businesses became more institutionalized. But you think about a lot of those families were, there weren't minorities that owned a lot of real estate, and so it was an industry that was primarily father to son. And so there weren't women really in the industry as well. And so then you think about, well, what was the talent funnel into our industry? It probably was 30% of our industry, were people that actually knew that the industry existed and was available to them from an opportunity perspective. So over the last, several years, what we've been trying to do whether it's SEO or at the PREA Foundation, or even what we're doing specifically here at KKR, is really to open up the awareness about real estate and alternatives. This is an industry, and it's a huge industry. It's a multi-trillion-dollar, employees, millions and millions of people, but people just didn't think about it as a career. And so a lot of what we're doing with, SEO or Girls Who Invest is just making people aware of it, because it's literally not rocket science. It's a very exciting career. And I think if we can broaden that funnel of people that know it exists, and then bring people into the industry through internships and getting people exposed to it, like I wasn't exposed through a family business. I was exposed through an internship at an investment bank. Then we're going to have more people that come in the entry level and then have opportunities to grow. And then I think what all of our firms need to do, and this includes us, Walker and Dunlop and others who are supportive of broadening this funnel, is once people get to your organizations, it's what are we doing to make sure people feel comfortable, feel supported, feel like they have a career path within that organization. And those were things, when you talk about, early years at Goldman Sachs, I felt that there. And so I met people who, I felt cared about me as a professional. And then that allowed me to get opportunities to, grow, work on deals. And that's then kind of leads to a career at that point. But I think that's the continuum, and it's every step of the way, we all need to be, doing our part, because I think ultimately we'll have a better industry. I think we'll get more ideas in our industry. We'll get more diverse viewpoints at the table. And I think it's something that I feel like it's happening, but our industry is a little bit late to the game there.
Yeah, I'd echo that. I guess the question I'd have is, you talk about big corporations like Chase, where you had your first internship. What Jamie has done as far as a senior management team at JP Morgan Chase is unbelievable as it relates to the diversity that he's put at the very, very senior ranks. And Goldman Sachs similarly has put a lot of people, very diverse senior management team. I think one of the things that I consistently hear is that at the senior levels of many of the firms, whether they're property owners or whether they're services firms, that there aren't many mentors who look like the aspiring woman or look like the aspiring minority to have that type of a mentorship. If that's kind of what cracks the code, it's going to take us a very long time to move all that up there. So is there any shortcut to that? Because that mentor-mentee relationship, women and minorities coming into the industry and saying, I can look at Chris Lee, is super important to them understanding a career path, to them getting the advice, the counsel, and the support, which we all need. I don't care how smart you are. We all need that support. We're all going to make mistakes. And I think in many instances, unless you've got someone who puts you under their arm and says, it's going to be okay tomorrow, many of us take a divergent path. And so without being able to, wave a magic wand and say, let's have our industry have at the top ranks look like Goldman Sachs or JP Morgan Chase, what can we do?
Well, I think that we have to believe that there are people that can mentor who aren't the people that mentor you or sponsor you. I think those are two very different things. Don't have to look like you. Like, why can't I be a mentor to a young woman? Why can't you? The people that have mentored me over my career, a lot of them have been white males. And that I think we have to break down that, yes, representation matters. You want to be able to see someone that looks like you, that's doing some of the same things, but ultimately how you get up that career path, you need someone in your management chain to really believe in you and sponsor you. That's how my career has developed. And that's been, how I've been able to grow my career here. That was how I was able to grow my career at Goldman. But it wasn't necessarily someone that looked like me, but it was someone that I found some common, interest with, and I worked hard. And at the end of the day, people want, people that can help them, create value. And so I think that that's where we have to, really move the conversation is we all have to, be comfortable mentoring people that might not look exactly, like us. And by the way, that's just one part of any of our, identities. There's all sorts of other things to build common ground around. But I think that that's going to be important if we want people to be able to advance their careers in organizations.
I think that's such an important point. And I would say when we were focused on how we could do training and growth of women at Walker and Dunlop, one of the programs that we looked at and really thought had huge merit to it is a program they have at PNC Bank called Men as Allies. And so rather than just having a women's group and a women's initiative that is all female based, it's really using men to be, exactly as you just said, the mentors and the proponents of growth of women inside their both specific groups as well as more broadly across the entire company. And we went and studied that program and implemented it at W&D, and it's been wildly valuable to us as having men as allies and not just sort of saying women's growth and career pathing at W&D has to be the responsibility of female executives and female managers.
Exactly. I think we have to evolve the conversation more in that direction, because there's no reason why someone can't mentor, someone from different, because at the end of the day, it's not just the mentorship, it's the sponsorship. And that's more important, putting people in positions where they can have visible opportunities to create commercial impact. That's what everyone wants an opportunity to do at Walker and Dunlop. That's what everyone wants to do at KKR, is have opportunities to create tangible commercial impact. And I don't think that has anything to do with, someone's race or gender.
Yeah. We are out of time, Chris. I am super, super appreciative of you taking the time. I had all sorts of other things to talk about with you. You and I will have the opportunity over dinner to finish up on my questions list about a number of different things that influence your leadership style. But I'm super appreciative of you spending this hour with me and giving all of us your insights on both how KKR real estate has become what it is and your views on the overall market today. And so just a big, big thank you for all you do and for spending the time with me.
I appreciate it. As always, it's a lot of fun, and it's my first webcast with you. So it's a real pleasure. And we enjoy the business that we do with you and Walker and Dunlop. So thanks for the opportunity, and go Chiefs.
Yeah, we never even got to that. So anyone understands the connection to that, the family that owns the Chiefs are all St. Mark's graduates, and so Chris is actually very good friends with the family, and we were talking about the fact that they might go win the championship this weekend. So there you go.
There are a lot of St. Mark's people are Chiefs fans, so I'm one of them. So go Chiefs.
It's great. Have a great Super Bowl weekend. Thanks, Chris, very much. And everyone who joined us this week, thanks. And we'll see you again next week.